In the U.S., both fiscal policy and monetary policy play crucial roles in shaping the economy, but they are often confused or misunderstood. While both policies aim to promote economic stability, control inflation, and support growth, they are different in terms of who controls them, how they are implemented, and their specific goals. This video explores the top 10 key differences between fiscal and monetary policy in the U.S., providing a clearer understanding of how these policies impact the economy and everyday life. 1. Definition and scope. Fiscal policy refers to the use of government spending and taxation to influence the economy. It is controlled by the federal government and is aimed at managing overall economic activity. Monetary policy, on the other hand, is the control of money supply and interest rates, managed by the Federal Reserve, the central bank of the U.S., to influence economic conditions like inflation, employment, and investment. While fiscal policy involves direct government actions like taxes and public spending, monetary policy adjusts financial conditions through tools like interest rates. 2. Key authorities. The federal government is responsible for implementing fiscal policy, particularly through the executive and legislative branches. The President and Congress decide on public spending, tax policies, and budget allocations. In contrast, monetary policy is controlled by the Federal Reserve, often referred to as the Fed, an independent central bank. The Fed sets interest rates and regulates the money supply to influence the economy. 3. Tools used. Fiscal policy primarily uses two tools: government spending and taxation. The government can increase or decrease spending on programs like defense, infrastructure, and social services, or adjust tax rates to stimulate or slow down the economy. Monetary policy, however, uses tools such as open market operations, buying, selling government securities, adjusting interest rates, and modifying reserve requirements for banks to control the money supply and credit availability. The goal of fiscal policy is to influence aggregate demand by either stimulating or contracting economic activity. The government might increase spending or cut taxes to stimulate demand during economic downturns, or increase taxes and reduce spending to slow down inflation. Monetary policy, on the other hand, primarily aims to manage inflation and stabilize the currency, ensuring that inflation remains within target levels and that interest rates remain favorable to encourage investment and employment. 5. Timeframe of implementation. Fiscal policy tends to have a longer implementation timeframe. For example, changes in taxation or government spending must be debated and approved by Congress, which can take time. Once implemented, the effects of fiscal policy may take months or even years to materialize. Monetary policy, in contrast, can be adjusted much more quickly. The Federal Reserve can make decisions on interest rates or money supply within days or weeks, and the effects can be seen more rapidly in financial markets and borrowing costs. 6. Impact on the economy. Fiscal policy directly affects the real economy. For example, tax cuts leave people with more disposable income, which can boost consumer spending and business investment. Similarly, government spending on infrastructure or social programs can create jobs and stimulate growth. Monetary policy, while still impactful, mainly affects the financial sector. Lower interest rates, for instance, can reduce borrowing costs for businesses and consumers, but the broader impact on spending and investment might be more indirect and dependent on consumer confidence and lending conditions. 7. Flexibility and control. The Federal Reserve has a high degree of flexibility and control over monetary policy. It can adjust interest rates and alter the money supply at will, often responding quickly to economic conditions. Fiscal policy, however, is less flexible because it involves government spending and tax decisions that must be approved by Congress, making it slower to change. Fiscal policy is also more vulnerable to political influences, whereas monetary policy is largely independent from direct political control. 8. Impact on inflation. Fiscal policy affects inflation indirectly through its impact on aggregate demand. For example, a government increase in spending or a tax cut can increase demand, potentially pushing prices higher if the economy is already operating at or near full capacity. Monetary policy, on the other hand, directly targets inflation by controlling the money supply and interest rates. The Federal Reserve raises interest rates to curb inflation and lowers them to stimulate spending and investment during deflationary periods. 9. Influence on employment. Both policies aim to influence employment, but in different ways. Fiscal policy can directly affect job creation through government spending on infrastructure projects, education, and healthcare, which can generate employment opportunities. Monetary policy influences employment more indirectly by adjusting borrowing costs. Lower interest rates encourage businesses to borrow and expand, potentially creating new jobs, while higher rates might reduce investment and hiring, slowing employment growth. 10. Long-term versus short-term focus. Fiscal policy often focuses on longer-term economic growth by investing in infrastructure, education, and other initiatives that can have lasting impacts on the economy. However, it can also be used for short-term stabilization during recessions or periods of economic instability. Monetary policy, on the other hand, is generally more focused on managing the short-term fluctuations of the economy. The Fed uses monetary policy to smooth out business cycles, stabilizing inflation and employment levels in the short run. While both fiscal policy and monetary policy are designed to stabilize the economy, they operate in different ways and are managed by different authorities. Fiscal policy, controlled by the federal government, relies on changes in taxation and spending to influence economic activity. Monetary policy, managed by the Federal Reserve, adjusts the money supply and interest rates to control inflation and foster financial stability. Understanding these differences helps clarify how economic decisions affect everything from government budgets to the price of goods and services, as well as broader economic trends. By recognizing how each policy works, individuals can better navigate the economic landscape and anticipate potential changes in interest rates, tax laws, and government spending.